Capital structure theories. So, what is capital structure? Capital structure is a combination of capitals. So, we know the capitals, that is equity share capital, preference share capital, and debt capital. So, these are the three capitals. So, how much portion we have to involve in the company, in the sense the quantum of capital, and from which source we have to raise the capital. So, at the time of raising capital, we have to be careful about the three factors, that is cost, control, and risk. So, always we have to maintain in such a manner that the overall cost of capital remains minimum. At the same time, we have to be very careful about the controlling power of the shareholders, the existing shareholders, and they must continue to hold majority stake. The third point is the risk, and at the time of designing the capital structure, the financial risk of the company does not increase beyond the tolerable limit, beyond the affordable limit. So, those are the three factors we have to be very careful while designing the capital structure. At the same time, it is very difficult to achieve all these three goals practically, because the primary objective while deciding the capital optimal capital structure is maximization of value of the firm, value of the company. So, what is the formula for the value of the firm or value of the company? EBIT by overall cost of capital. Overall cost of capital in the sense, so the mix of the capitals, either cost of equity or cost of debt, cost of preference. So KE plus KD likewise. So overall cost of capital. Capital structure decision will decide weight of debt, equity, and ultimately overall cost of capital as well as the value of the firm. So this is the one which is very important. Capital structure is relevant in maximizing the value of the firm and minimizing the overall cost of capital. So, is there any effect if we maintain the capital structure in a particular way? Is there any effect on the value of the firm? Is there any effect on the minimizing the cost of capital? So, there exists the point of theories. So, capital structure theories. Some philosophers created theories, developed theories saying that capital structure is relevant in maximizing the value of the firm and minimizing the overall cost of capital. Some academics or philosophers developed some theories saying that it is completely irrelevant. So that is why the capital structure theories are divided into two types. Two types, that is capital structure relevance theory and capital structure irrelevance theory. So relevance theories are net income approach, traditional approach, and irrelevance theories are net operating income approach and Modigliani-Millen approach. So traditional approach. The traditional theory of capital structure tells that wealth is not just created through the investment in assets which are having positive returns. So while purchasing those assets, with maintaining the optimal blend of equity and debt portion. Say, for example, while we are learning about the sources of finance, we talk about the finance which is raised from the long term sources, we have to invest that finance into the long term assets, right? So, at that time, such long term finance must have the blend of equity and debt. So, if we maintain a proper structure, a right combination of a debt equity mix in capital structure, then we can easily achieve the maximum value of the firm and with the minimum cost of capital. So, as per this approach, debt should exist. Debt should exist in capital structure only up to specific point, beyond which if we if any increase beyond that point, so it results in the reduction in the value of the firm. So it means that there exists an optimum value of debt to equity ratio at which weighted average cost of capital is lowest and the market value of the firm is highest. So if we keep on increasing the debt portion in finance, say for example, we are using 1 lakh rupees to purchase one asset. From where you get that 1 lakh rupees? Did you borrow completely, or did you um, um, used it from the equity, or did you mix up those equity and debt at what portion? So that combination, if you if you are mixing those equity and debt, so at what combination you are using? So in this theory, what they are telling is debt should exist in that portion, in that 1 lakh, but it should be in a limit up to specific point. After that point, even if you use debt, more debt, then it causes in reduction in value of the firm. That is what this approach is saying. So principal implication of this approach is that the cost of capital is dependent on capital structure, is dependent on the capital structure. So here what I am trying to say is traditional approach is relevance theory. Relevance theory in the sense there is a relevance. See, capital structure is relevant in maximizing the value of the firm. Okay, so traditional theory is supporting this one in the sense cost of capital is dependent on the capital structure and depends on the degree of leverage. Degree of leverage. So how much portion of debt you are involving while purchasing an asset. Okay. So there is an optimal structure which minimizes the cost of capital. Okay. Assumptions under this approach. These are the important assumptions. The rate of interest on debt remains constant. The expected rate by equity shareholders remains constant or increase gradually. After that, the equity shareholders starts to identify a financial risk, and then from the optional point and the expected rate increases speedily. So expected rate by the equity shareholders remains constant. As a result of the activity of rate of interest and expected rate of return, the weighted average cost of capital first decreases and then increases. The lowest point on the curve is a optimal capital structure. If you do observe these two diagrams, both are same. So first point, the rate of interest on debt. So this is the cost of debt curve. Here also cost of debt curve. The rate of interest on debt remains constant for a certain period, and thereafter, with an increase in the leverage, it increases. If you keep on increase the leverage in the sense debt portion, if you keep on increase the debt portion, then it increases. The expected rate of return, the expected rate by equity shareholders remains constant or increase gradually. It may remain constant or increase gradually. After that, equity shareholders starts to identify the financial risk, and then from the optimal point from the optimal point from the optimal point, the expected rate increases speedily, and as a result of the activity of rate of interest and expected rate of return, as a result of rate of interest and expected rate of return, the weighted average cost of capital first decreases and then increases. So this is the point where weighted average cost of capital has the lowest. In the sense, at this point, cost of capital is very low, and at this point, the value of the firm is high. So this is the optimal point, optimal capital structure. So at this optimal point, the portion of equity and the debt mix has the right combination. The optimal capital structure occurs at point where value of firm is highest and the cost of capital is lowest. So this is the optimal capital structure point. This can be explained through illustration perfectly. So in this traditional approach, what they are saying, debt should exist. What if debt portion is not there? Okay, debt should exist in capital structure only up to specific point, beyond which any increase in leverage would result in reduction in the value of the firm, in the sense increase in the overall cost of capital. Okay, so it will be explained through illustration. See, Indra Limited has EBIT of 1 lakh. The company makes use of debt and equity. So makes use of debt and equity. The firm has 10% debentures, that is 5 lakhs, and firm's equity capitalization rate is 15% expected rate. You are required to compute current value of the firm, overall cost of capital. Okay, ignore it. What we want to show is, so if we increase the debt portion, sorry, this is not the right illustration. This is the right illustration. See, this is the cost of debt and this is the cost of equity. So what if the debt portion is not there? So if you keep on increase the debt portion, debt percentage in the total value, so what will be the effect in the total value of the firm. Okay, see, overall cost of capital. If debt is 0, overall cost of capital is 13. If debt is zero point 0.1, overall cost of capital is 12.8. So if we keep on increase the debt portion 0 0.2, 0 0.3 and 0. These values are cost of debt 11%, 11%, 11.6, 12 percentage and 13 percentage. So cost of debt, if we keep on increasing, see, if you see the assumptions in the traditional approach, the rate of interest on debt remains constant for a certain period, and thereafter, with an increase in leverage, it increases. Okay, so in this illustration, see, rate of interest is constant for a certain period. Thereafter, with an increase in leverage, it increases. So, the value of the debt, if you keep on increase the value of debt, value portion, so debt portion, if it is 0, it is 13 percentage. This is the cost of equity and the value of the equity. So, this is the value of the equity 1 9. If it is debt is 1, equity is 0.9. Debt is 0.2 and equity is 0.8. So, this is the mix. Debt portion is 0.2 and the equity portion is 0.8. So, at this mix, cost of capital, overall cost of capital is 13.52. If we keep on increasing the debt portion in the mix, so these are the values of cost of debt. So these are the values of overall cost of capital. So at particular point, overall cost of capital is minimum. This is the optimum capital structure. So as per the assumptions, as a result of the activity of rate of interest and expected rate of return. So as a result of rate of interest and expected rate of return, the weighted average cost of capital first decreases and then increases. First decreases, see, first decreases and then increases. So the lowest point is the optimum capital structure. So this is the point where the value of the firm is maximum and the cost of capital is minimum.